Here's everything you need to know about stocks versus ETFs in 30 seconds. Both stocks and ETFs can be bought right on the stock market exchange through your brokerage like Fidelity, Vanguard, or Schwab. Investing in stock is like buying one slice of pizza. You're betting on one company like Apple or Tesla. If the slice is good, great. But if the slice sucks, you're kind of out of luck because that's all you have. An ETF is like buying an entire box of pizza where all the slices are different flavors. So if you get one bad slice, no problem. There's other ones that you can pick from. So for example, VOO is an ETF and it holds 500 of the biggest US companies all in one fund. So if you own VOO, you basically own a piece of 500 of the largest companies in the US. Stocks give you more upside if you pick a winner, but ETFs are less risky and easier to build wealth over the long term. Make sure you're following me for more tips on how to build your money and wealth.
Welcome back to Profit Pulse, where financial clarity meets everyday life. Today, we're diving into one of the most common investing questions. What's the difference between stocks, ETFs, and index funds? You've probably heard these terms thrown around by investors, finance gurus, or even co-workers. But what do they really mean, and which one is best for you? By the end of this video, you'll understand exactly how each investment works, their pros and cons, and how to choose the right one for your financial goals. So, if you're ready to take control of your money and build smarter wealth, let's get into it.
The way that financial influencers explain the difference between index funds and ETFs makes it so confusing. Let's fix that. An index, it's a database or a map that serves as a list or a guide. You find these in the back of books or in coding. You would index data into groups for mapping. An index, it's simply a list of stocks. It can also be a list of bonds or other investment products. The most commonly known index is the S&P 500. This is an index made up of 500 of the largest US companies. You probably heard of that one before. A fund is an investment product where a bunch of people pull their assets together. It's like a group gift. You can buy a lot more things. There are a lot of different types of funds that you may or may not have heard of, like mutual funds, hedge funds, exchange traded funds. Anytime you hear the word fund, think a lot of people funding. The person organizing that group gift, that's the fund company. They're managing the fund to its stated objective. This is called the investment objective. You can see that on your brokerage firm's website. An ETF is an acronym that stands for Exchange Traded Fund. Everything in finance is in its name. Exchange means that an ETF is listed on an exchange, just like a stock, which means they are easily accessible. Traded, ETFs trade throughout the day, which means prices change throughout the day. And then fund, this is a type of fund like mutual funds. They're a pool of assets that you bring together to buy more. An index fund can be a mutual fund or it can be an exchange traded fund. An index fund is simply a fund that tracks an index. It replicates the investments within that database. What's the difference between an ETF and an index fund? An index fund is a type of ETF. Just like a rose is a flower and a type of flower is a rose. Comment what finance term you find confusing. You know what buttons to hit to follow along. Time to get FinFluent, not FinFluent.
Here are 2 ETFs that I'm buying consistently in 2025. If you're new here, hi, my name is Virginia and I grew my stock portfolio 226% in 4 months. If you're interested in growing your wealth, click the follow button below. Number 1, QQQM. This tech-heavy ETF tracks companies like Apple, Google, Meta, Tesla. This is perfect for new investors that are looking to diversify within the tech space. This ETF allows you to keep your risks low and your management fees lower. Number 2, Vanguard's S&P 500 or ticker symbol VOO. Vanguard's S&P 500 tracks the largest US companies. We're talking United Healthcare, Netflix, Visa. It is a classic for long-term growth and it also has one of the lowest management fees in the market. VOO makes up about 60% of my investment portfolio because of its historical ability to bounce back from economic downturns. What ETFs will you be buying in 2025? Let me know in the comments.
What's the difference between an index fund and an ETF? An index fund can be an ETF or a mutual fund, but an ETF is not always an index fund. So for example, you can see VOO is an S&P 500 ETF, but it's an index fund because it says right here, management style index. But you can also purchase ETFs that are sector ETFs. You can purchase actively managed ETFs like this one where somebody's literally inside there trading. All ETFs are not index funds. Now, here's how ETFs are similar to mutual funds that are index funds. They're both going to have a bunch of different things inside of them. But depending on the type of ETF, you may have a couple of stocks inside of there, or you may have hundreds and thousands depending on the type of ETF that it is. The biggest differences for like a lazy investor, someone who's buying and holding onto the investment, is that with ETFs, you can't usually automate your ETF investing unless you're using a robo-advisor or like a M1 Finance. Fidelity, I think, just started rolling out automated ETF investing, but most of the time, because you can buy and sell ETFs all day long, you can't really automate it on traditional brokerages. With mutual funds, you can automate mutual funds on any brokerage out there. Hopefully that answers your question a little bit, but if you have further questions about it, I've got an entire podcast episode on this at the Money Bear. Let me know what other questions you have.
Here are the only 5 index funds and ETFs that you will ever need for the rest of your life. I'm Tyler. I'm a former financial advisor and portfolio manager. Now I make financial content for free so that you don't have to pay for it. Number 1, a low-cost index fund or ETF that tracks the total US stock market. Stop wasting your time picking individual stocks and just invest in the entire US market. Number 2, a low-cost index fund or ETF that tracks the total international stock market. China and India are growing at an incredible rate, and a decade from now, you might want to be exposed to those markets. Number 3, a low-cost blue chip dividend fund. I am becoming increasingly obsessed with blue chip dividend funds. 50 years ago, we were drinking Coca-Cola. Today, we're drinking Coca-Cola. In 50 years, we're going to be drinking Coca-Cola. Number 4, a low-cost intermediate corporate or government bond fund. I'm not a big bond guy, and they're not nearly as safe as you've been told they are. They do take a little volatility off the portfolio, can give you a healthy cash flow. Number 5, a low-cost real estate investment trust index. Because they have to pay out 90% of their profits each year in the form of dividends, you can get a better return than in the bonds or the dividend fund. So take your time, choose wisely, keep it simple, you'll be all set.
Oh, so you're finally ready to buy some index funds or ETFs, but you don't know what you're looking for. Come on, I'll show you. So let's use the Vanguard S&P 500 ETF. This ticker symbol is VOO. The first thing you want to do is go in this product summary and read it, because it's going to tell you exactly what the purpose of this ETF is. The next thing you want to look at is the expense ratio, because yes, index funds and ETFs are not free. They usually have an expense ratio. Here it's 0.03, which means for every $10,000, you only paid $3. That's awesome. The next thing you want to look at is the tab that says price and performance, because you want to see how this ETF is performing against the index that it's supposed to be tracking. So here's the S&P 500 ETF, here's the index, and you can see it's tracking pretty similarly. That's great. Then you want to go into portfolio management, scroll down, and it will show you the top 10 holdings inside that portfolio. 28% are these top 10 companies.
Welcome to Rich Talk. 4 biggest differences between ETFs and mutual funds explained. 1. ETFs are passively managed, meaning they follow an index, kind of like how your little brother follows you around the house, whereas mutual funds are actively managed, meaning there's somebody in the back swapping securities in and out trying to beat the market. 2. Mutual funds typically have higher fees, in part reflecting all that extra work. 3. ETFs are traded on an exchange and their price fluctuates all day as it's bought and sold. Mutual funds can only be traded once a day after the market close. 4. ETFs are more tax efficient because of the way they were created and redeemed. All in all, both are great tools for a diversified investment strategy, though beginners may prefer ETFs as they cost a lot less to get started.
Let's talk about buying individual stocks versus index funds. I found a statement from 2014 when I just started investing. I was using an advisor and he had me in individual companies. So I had Microsoft, 125 shares for $47 a share. Guess what it is today? It's over $400 a share. It would have been a $52,000 gain throughout the last 10 years. And while this may sound amazing, this is a very risky strategy to put all of your eggs in one company. You never know what's going to happen with these companies over time. For all we know, Microsoft could have tanked. I Googled what companies had the worst shares in 2023, and these are the 5 companies. One, returning a negative 75%. So any money you put in there would have just completely been poof out of the air. Negative 75% return. So let's talk about how an index fund differs. If you're investing in the stock market with index funds, either like an S&P or a total market fund, you are getting your money put into all of those companies, like little pieces of all of those companies. And so this makes your portfolio very diversified. And so if you're doing a total market, you are getting all of the S&P companies plus some small, mid, and large companies mixed in there. So you're kind of getting a full gamut, and that's why J.L. Collins recommends doing total markets. And S&P is just simply the 500 top companies on the stock market. So instead of just putting all of your money in one company, you're getting a whole piece of a lot of them, which historically and statistically does pretty well for you. And please remember, I'm not a financial advisor, so take this advice for what you will and follow for more beginner investing tips.
You need to start investing and you know it. And knowing the difference between stocks, ETFs, mutual funds, and index funds can save you more than $80,000. And it's really not that hard to understand. A stock is one single company, like the Apple stock or the Tesla stock. When you buy stocks, you're putting your money in one company. An ETF is a basket of stocks all in one. A popular one is the Vanguard S&P 500 ETF. When you buy an ETF, you're putting your money into hundreds of different stocks. A mutual fund is also a basket of stocks, but it's actively managed. That means there's a money manager that actively buys and sells stocks to beat the average return of the stock market. When you buy a mutual fund, that means you're putting money into a fund where there's a professional manager trading stocks, but it does have higher MER fees. An index fund is also a basket of stocks, but it's passively managed, meaning there's no professional manager actively working. Index funds just want to mirror the stock market, not actively try to outperform it. And since there's no fund manager, the fees are way less. I have a more in-depth video about these investment choices, so if you're serious about starting to invest, make sure you watch that video to avoid these hefty fees. Also, like this video and follow me for more financial content.
Let's talk about the difference between ETFs and index funds, also known as mutual funds. I see a lot of people interchange these terms, and while they are similar, they're not totally the same thing. So let me break down the differences. The overarching similarity between the two is that they both are investment options that offer a wide range of diversification of different assets. They are both baskets of stocks. So when you invest in an ETF or an index fund, you're getting exposure into multiple different asset classes and improving your diversification. The biggest difference comes in trading. You can see with ETFs, they trade just like similar stocks. So you can trade them at any moment throughout the business day, meaning that the price you trade at can vary from person to person. As opposed to a mutual fund, you could only trade once per day at the end of the day, meaning everyone gets the exact same price at the end of each day. And the second main difference is buy-in. For ETFs, there is no buy-in required, whereby for index and mutual funds, you usually have a set dollar amount you need to have before you can buy it. So it all depends. Usually people who are just getting started in their investing journey and don't have a ton of money lying around will opt for ETFs, whereas people who have a lot more money around will probably opt for a mutual fund. And the last difference is active versus passive management. ETFs are generally passively managed, while mutual funds are actively managed. So say, for example, when you buy an ETF that tracks the S&P 500, you'll just be tracking the S&P 500 within that ETF. As opposed to buying a mutual fund, those funds are actively managed, which means those managers might buy or sell different stocks within each mutual fund. So the companies that you own within those mutual funds are subject to change. So there's a quick overview on the difference between ETFs and index or mutual funds. Hope this clears things up.
What's the difference between a mutual fund and an ETF from somebody who's worked in finance for 15 years? A mutual fund and an ETF are both the type of fund. A fund in the investing world is like a group gift. A bunch of people put in their money, they can access more securities. So it's a basket of securities that could be stocks, bonds, funds, cash, lots of different investment products. And that fund has an investment objective. What are we doing with these funds? What is the group pulling their money together for to purchase? And it gives you access to more. Not necessarily diversification, but more, because you could have more stocks in one sector. You could have more bonds. You could have more funds. There are literally funds of funds. A fund allows you to buy a lot of things with just one fund. Every finance term is in its name, and you would know that if you listen to my podcast. Mutual fund was created first in 1924. It's where we mutually pulled our assets together in order to buy a lot of things. Exchange traded fund, or an ETF, is the innovative version of a mutual fund. The first one was created in 1993, and it actually was SPY, which is a passive fund that mirrors an index, something we'll talk about in a moment. And there's some differences in symbology. You can totally look at this and see which is which. All mutual funds have 5 letters and end with an X in the symbol. That's how you know it's a mutual fund, purely by looking at it. They trade only 1 time a day. There's a cutoff time, and then literally the mutual fund manager is going to go buy the shares that you need to go into that fund of whatever meets that investment objective. Now, an exchange traded fund In the name, it trades on the exchange. Do you know what else trades on exchanges? Stocks. That's why it's considered an equity. An equity is also a stock. It trades throughout the day, mostly passive, which means it copies something like an index. SPY or SPY or VOO, those all mirror an index. So it copies whatever that index is doing. That's what passive means. Because they trade like a stock, there's no minimum price. The price at which you could buy that is whatever it's trading at. Mind you, this is before fractional shares was a thing. Because of that, there are lower fees. It's more accessible. You can buy it or sell it as much as you want. There are other implications, but that means it's more accessible. Whereas a mutual fund, they're mostly active. That means that a fund manager is actively making decisions. Get it? See, literally everything is in the name. They have a higher minimum. Normally you have to buy in minimums of $500. You can also buy in dollars or shares. Again, this is before fractional shares was a thing. But because of this, they have higher fees because of the active management. Those fees actually vary depending on your brokerage firm. Because of all these fees, it's actually more intended for the longer term investor, because if you were to sell out of it early, it's probably going to cost you in addition to tax implications. Most importantly with funds, read the prospectus. It's like a user manual.
Personally, I don't invest in stocks. I just buy index funds. They're a way better way to diversify my portfolio, but they do come with additional costs. So here's a little explainer on how to find the index funds with the lowest fees. I thought investing was free now. Sort of. While trading platforms are no longer charging commissions for transactions, mutual funds, ETFs, and other baskets of investments still do charge fees. Someone has to do all of the work of putting them together, or at least pay to develop that tech, right? And now you're wondering, where do I find out how much these baskets of investments cost? It's called an expense ratio, a fee that you'll pay out of your gains or on top of your losses. For example, you have an investment that has a 0.1% expense ratio. If you make 8% in gains, you'd actually make 7.9%. If that same investment were to have lost 5%, you would actually lose 5.1%. Expense ratios are important because sometimes similar investments have very different expense ratios, such as SPY versus VOO. Both funds track the S&P 500, but with this one, you'll pay a third of the fees. Let me know what finance topic you'd like to see me cover next.
Index funds 101. Let's talk about the difference between index funds, mutual funds, and ETFs. Now, if you're looking to invest in an index fund like an S&P 500 index fund, you can buy this index fund as a mutual fund, or you can buy it as an exchange traded fund, also known as an ETF. Now, examples of S&P 500 index fund mutual funds are VFIAX from Vanguard, FXAIX from Fidelity, and SWPPX from Schwab. And examples of S&P 500 index fund ETFs are VOO from Vanguard, SPY from State Street, and IVV by BlackRock. Index fund mutual funds definitely have some distinct features that make them unique. And index fund ETFs also has some distinct features that make them unique. So let's talk about them. Number one, index fund mutual funds can generally only be purchased directly from the fund company. And what I mean by that is if you were to invest in VFIAX, you'd have to open a Vanguard account, FXAIX, a Fidelity account, SWPPX, a Schwab account. On the other hand, index fund ETFs can be purchased via any broker of your choosing. So to buy any of these ETFs like VOO, SPY, or IVV, you could use TD Ameritrade, M1 Finance, Robinhood, or even apps like Cash App that let you buy stocks. Number two, index fund mutual funds are generally easier for setting up automatic investments. So let's say you wanted to invest $1,000 from every paycheck into VFIAX. Well, mutual funds will generally make setting up these automatic investments much easier. And in my opinion, this creates discipline, and it's great for dollar cost averaging into an index fund. On the other hand, with ETFs, not all brokers offer automatic investing. So in the same scenario, if you wanted to invest $1,000 out of every paycheck into an S&P 500 index fund, you'd probably have to manually do it every pay period. And the third distinct feature of an index fund mutual fund is that your shares in that mutual fund are bought and sold at the end of the day. But with ETFs, they can be bought and sold intraday. So if the S&P is down 2% at 10 a.m., I can place a buy order right then and there, and my order will be filled immediately. But at the end of the day, both are great options. They both offer low fees and expenses, and whether you invest in the mutual fund or the ETF, they both have the same performance, assuming they're tracking the same index and using the same strategy. At the end of the day, it really comes down to investor suitability and investor preference. If you want one-on-one financial coaching to learn more about index funds, please click the Stan Store link in my bio.
Invest in stocks, mutual funds, or index funds. This blue M&M represents the stock of one company. For example, you can invest in Amazon, Apple, or Google. Investing in one or two M&Ms can be risky. One company might make you a lot of money, but you can also lose a lot of money if another company's value goes down. But you can lower your risk by investing in mutual or index funds. Mutual funds are like giving your M&Ms to a candy expert. They pick what they think are the best ones. Maybe they really like green and red M&Ms. For example, some mutual funds may be highly concentrated in tech stocks, which typically have a higher return, but the manager charges a high fee. They take a few M&Ms from your stash every year, win or lose. Index funds are like getting a whole variety pack of M&Ms, no picking favorites. They follow a whole market index like the S&P 500, which tracks the top 500 companies in the US. They're passively managed, so no candy manager. They have a lot lower fees, so you keep more of your candy, and they historically return around 7% per year. So what should you pick? If you want to set it and forget it, index funds are a great long-term strategy, but if you love researching stocks and don't mind a little bit more risk, a mix of stocks and funds could work well for you. Like and follow for more snack size investing tips.
If you invest in the stock market and you don't pay attention to this one tiny detail, it could be costing you hundreds of thousands of dollars. Let me explain to you what I mean and exactly what I'm looking for. So if you invest in index funds and ETFs within any of your stock brokerages, you'll notice that there's a thing called an expense ratio. An expense ratio is simply just a portfolio management fee for managing your specific fund that you're investing in. So as an example, I invest in VU within my Roth IRA and it has an expense ratio of 0.03%. So in this example, for every $1,000 that I invest in VU, I have to pay $3 in portfolio management fees. Now that might not seem a lot, but as your portfolio grows into hundreds of thousands and millions of dollars, your portfolio management fees will significantly increase. Now let's say that you buy VU over the next 30 years and you contribute $15,000 per year. Well, your portfolio value will grow to $2.7 million and you'll pay over the span of 30 years, you'll pay roughly around $16,000 in management fees. Now let's use this exact same example, but we increase our expense ratio to 0.5%. The gross value of our portfolio will still grow to $2.7 million, but the difference is we paid over $250,000 in portfolio management fees relative to the $16,000 we paid here in this example by investing in VU. So guys, it's very, very critical that you guys look at the expense ratio. Generally speaking, my rule of thumb is I never want to go above 0.1%, and ideally you stick below 0.06%. I've seen people invest in index funds where the expense ratio is 0.2% or higher, and guys, you want to avoid those type of investments. Keep your investments a low cost.
So there you have it. Stocks, ETFs, and index funds explained in plain English. Remember, the best investment isn't about chasing trends. It's about building long-term growth that fits your goals and risk level. If you found this breakdown helpful, hit that like button, subscribe, and turn on notifications so you never miss a pulse on your financial future. This is Profit Pulse. Stay smart, stay steady, stay profitable.